Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cathay Pacific Airways Limited annual report. Cathay Pacific Airways Limited offers a wide range of services to cater to the diverse needs of its customers. The company provides international air transportation for both passengers and cargo, operating scheduled flights across various regions including the Americas, Europe, Southeast Asia, North Asia, South Asia, the Middle East, and Africa. In addition to airline operations, Cathay Pacific also offers a variety of supporting services such as catering, cargo terminal operations, ground handling services, and commercial laundry operations. These services enable the company to provide a seamless travel experience for its passengers while ensuring that their cargo is handled efficiently and safely. The company operates a fleet of 234 aircraft, with plans to expand its fleet by introducing 93 new passenger and freighter aircraft. This expansion will not only enhance Cathay Pacific's operational capacity, but also improve its ability to meet the growing demand for air travel and cargo transportation in the global market. Cathay Pacific Airways stock price has experienced a notable increase over the past year, with a 29.2% one-year total shareholder return as of March 12, 2026. Several factors have contributed to this surge in stock price. One major factor is the airline's robust financial performance in 2025. Cathay Pacific reported a substantial 9.5% increase in its full-year profit for 2025, surpassing analyst expectations and marking the airline's third consecutive year of profitability since the pandemic. Revenue also surged by 12% to a record $116.8 billion. Another significant factor is the strong recovery in passenger traffic and resilient cargo demand. Passenger numbers soared by 26.5% to 28.9 million, contributing to a 15.8% increase in passenger revenue. Cargo operations also remained robust. The airline's management has announced ambitious plans to increase passenger capacity by approximately 10% in 2026, which includes introducing more frequent flights, adding new destinations, and taking delivery of 8 new narrow-body aircraft. This expansion signals a positive outlook for future growth. Additionally, Cathay Pacific increased its dividend, with the full-year dividend per share rising by 21.7% and the second interim dividend by 30.6%. The airline has also implemented fuel surcharges to mitigate the impact of volatile oil prices, ensuring efficient flight operations and managing fuel costs effectively. The surge in demand on key routes, particularly long-haul flights to Europe, the U.S., and Australia, has also contributed to Cathay Pacific's stock price increase. This is partly attributed to passengers seeking alternative routes due to geopolitical tensions in the Middle East. Overall, these positive news events and strong financial performance have driven Cathay Pacific Airways' stock price increase over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for Cathay Pacific and its subsidiaries can be attributed to several key factors. On the growth side, an increase in available seat kilometers, ASKA contributed significantly to revenue growth, with Cathay Pacific experiencing a 25.8% rise and HK Express seeing a 31.9% increase. This led to higher passenger revenues, with Cathay Pacific's revenue increasing by 15.8% and HK Express revenue rising by 6.7%. Additionally, traffic RPK increased by 28.9%, further boosting revenue. In terms of regional growth, the data reveals that certain regions performed better than others. The South Asia, Middle East, and Africa region experienced a remarkable 39.6% growth in revenue, followed closely by Europe with a 22.8% increase. North Asia saw a 7.2% growth, while the Americas and Southeast Asia and Oceania recorded 9.6% and 16.9% growth respectively. On the other hand, yield decreases were observed across all three airlines. Cathay Pacific's yield decreased by 10.3%, while Cathay Cargo experienced a 4.6% drop in yield. HK Express yield fell by 15.3%. These declines in yield suggest that despite increased revenue from higher passenger numbers and available seat kilometers, the airlines struggled to maintain their pricing power. Overall, the data highlights the importance of managing capacity and pricing strategies to drive revenue growth. While certain regions performed better than others, the yields for all three airlines declined, indicating a need for more effective yield management practices. The financial performance of the company has undergone some changes over the past period. Notably, net income has increased by 9.5%, rising from $9,888 million to $10,828 million. This growth in net income is a positive indicator for the company's overall financial health. However, despite this increase in net income, profit margins have actually decreased. Specifically, they have dropped by 0.2 percent points, falling from 9.5% to 9.3%. This decline in profit margins suggests that while the company may be generating more revenue, it is not necessarily becoming more efficient or effective at converting that revenue into profits. The company is indeed generating positive operating cash flow. This can be seen in the significant increase in both cash generated from operations and net cash inflow from operating activities over the past year. In 2025, the company reported a substantial $23,421 million in cash generated from operations, indicating a strong ability to generate funds from its core business activities. Furthermore, the net cash inflow from operating activities reached an impressive $25,381 million, demonstrating a robust financial performance. A comparison with the previous year's figures shows that both metrics have increased, with cash generated from operations rising by 15% and net cash inflow from operating activities increasing by 8%. This upward trend suggests that the company is becoming more efficient in its operations and generating more value from its core business. The company's debt level has undergone significant changes in recent years. According to the extracted summaries, net borrowings have decreased by as much as -23.1% when excluding leases. This reduction is also reflected in the adjusted net borrowings, which have dropped by -22.8%. The net debt/equity ratio has also improved, decreasing from 1.1 times to 0.78 times. In addition to the decrease in debt levels, interest expenses have also seen a notable decline, from HK $3,897 million to HK $3,169 million. There is a reduction of HK $728 million in interest expenses. This change suggests that the company has successfully managed its financial obligations and reduced its reliance on borrowed funds. Overall, these changes indicate a positive shift in the company's financial health, with decreased debt levels and lower interest expenses contributing to improved stability and efficiency. The management is optimistic about the company's outlook, citing 3 consecutive years of solid financial performance. This achievement serves as a foundation for their ambitious plans to invest heavily in fleet renewal and expansion. A key aspect of this strategy is growing passenger capacity by 10% in 2026 through strategic additions of frequencies and destinations. The management's confidence in the company's future is unwavering, indicating a strong commitment to executing these plans and driving growth. Qatar Airways has made significant moves in its business operations through acquisitions and divestitures. In terms of acquisitions, the airline has strengthened its partnership with Cathay Pacific by increasing its shareholding. Additionally, Qatar Airways has exercised purchase rights for an additional 14 Boeing 777-9 aircraft, bringing its total commitment to 35 such aircraft. On the other hand, the airline has also made strategic decisions regarding divestitures. This includes buying back preference shares, warrants, and convertible bonds, which is a move to optimize its financial structure. Furthermore, Qatar Airways has decided to write off losses incurred by HK Express, a subsidiary of Cathay Pacific. These moves demonstrate the airline's efforts to streamline its operations and make strategic investments in its business. The company's financial activities have been notable in recent years. One significant aspect is its dividend payments. According to the provided information, the company has indeed paid dividends for both the 2025 first interim dividend and the 2025 second interim dividend. The total amount of these payments was HK $5,228 million. In addition to paying dividends, the company has also been active in share buybacks. Specifically, it has bought back shares from Qatar Airways Group QCSC, acquiring a substantial number of shares at a price of HK $10 and 8,374 cents per share. This transaction involved 643,076,1 181 shares being repurchased by the company. Concerns about inventory buildup or supply chain disruption are indeed present in the industry. The ongoing supply chain disruption is causing delays in delivering new aircraft, cabin products, and parts. This issue is not limited to a specific company, but is an industry-wide problem. Furthermore, Pratt & Whitney engine issues have led to some aircraft remaining grounded. These problems are contributing to the existing supply chain disruptions, making it challenging for companies to maintain their inventory levels. The cumulative effect of these issues may lead to significant delays and increased costs in the future. That concludes the financial summary for Cathay Pacific Airways Limited. Feel free to comment below, and I will be happy to answer them when possible.